Greetings and welcome to the lesson. Today we are going to discuss the nature and objectives of an audit. And in our last session, we defined an audit as an independent examination of an organization's financial statements, records, and operations. And this examination is conducted by a qualified professional known as an auditor who possesses or who assesses the financial information that is presented by the management. So an audit, first of all, is an independent examination. Independent examination means that this examination is done by a third party in a corporate setup, because in the corporate world, we have the ownership and control, the owners and the managers. Those are the owners being the first party, managers the second party. The owners delegate the responsibility of running the company to the managers, and therefore the ownership and management is separate, which in our last session we saw poses the agency problem. And to mitigate the agency problem, there is need to have independent examination of an organization's financial statements, records, and operations, which I'm now saying is conducted by a qualified professional who is known as an auditor, who may be an individual or an audit firm. And this auditor assesses whether the financial information presented is fair, accurate, and whether it complies with applicable accounting standards and regulations. So auditing or audits are typically conducted on an annual basis for most organizations, although we may have some that may require more frequent audits due to their size, due to industry, or due to regulatory requirements. So the primary objectives of an audit include, we are studying the objectives of an audit. The primary objective, one primary objective of an audit is to provide reasonable assurance. This is one primary objective of an audit, to provide reasonable assurance. The auditor's main goal is to provide a high but not absolute level of assurance, because absolute assurance may not be possible due to other factors that we are going to study later on. But one primary objective of an audit is to provide reasonable assurance, to provide a high but not absolute level of assurance that the financial statements are free from material misstatements. And that means that the auditor has conducted sufficient testing and analysis to conclude that the financial information presented is reliable and can be trusted by the stakeholders. So an auditor is required to examine the records, supposed to carry out tests, is required to carry out analysis of the financial statements, to conduct sufficient testing in order to gather sufficient evidence upon which he can make his opinion as to whether the financial statements that are presented are reliable, are fair, and can be trusted by the stakeholders. So that is one primary objective of an audit, to provide reasonable assurance. The second objective is to enhance credibility. Enhance credibility. to enhance credibility. An audit enhances the credibility of the financial statements by providing an independent, unbiased assessment of their accuracy and reliability. And that is crucial for investors, that is crucial for creditors, that is crucial for other stakeholders who rely on the financial information to make sound decisions. For example, before buying the shares of a company, one may want to know if the company is doing well, if the company is worthy of investing in. And to be able to know the performance of an organization, the financial position of an organization, then it is necessary that one relies on the work that has been done by an independent person, because you cannot rely on the report of the management. One has to rely on audited financial statements, which are carried out by a qualified professional who assesses whether the financial statements presented are fair, accurate, or they comply with regulations. So statements, financial information that has been audited is credible. Why? Because such information is examined by a qualified professional who gives an opinion as to whether the financial statements as presented are accurate, credible, and reliable. Do you understand? Auditing enhances credibility of the financial statements. Auditing may also identify weaknesses and recommend improvements. Identify Auditing can help to identify weaknesses and recommend improvements. Auditors can, in the process of carrying out their work, they assess the effectiveness of an organization's internal controls, which are the policies and procedures that are put in place to safeguard assets and to ensure the accuracy of financial information. These internal controls are also put in place by an organization to promote operational efficiency. So in the process of examining these internal controls, the auditor may come across weaknesses within that system. The auditor may identify weaknesses. Then upon the identification of the weaknesses, the auditor recommends improvements to strengthen the internal control system. So that is another objective of an audit, is to identify weaknesses and then recommend improvements, because auditors are qualified professionals. 4, deter fraud and error. An audit can deter fraud, it can deter error. The audit process acts as a deterrent. It acts as a deterrent to fraud and error by increasing the likelihood of detection. Now, while an audit is not designed to uncover all instances of fraud, it can help to identify potential risks and weaknesses that could be exploited by fraudsters. So in the process of examining the financial statements, in the processes of examining the internal control system, the auditor may help identify those loopholes that may be used to commit fraud or errors in the accounting system of a company. Then the last objective is in relation to compliance with regulations. compliance with regulations. Now, in some cases, audits are required by law or regulation to ensure that organizations are complying with specific financial reporting requirements. And I know all of you are students of financial reporting. I know you are conversant with the international financial reporting standards, the international accounting standards, and you know by now that financial statements are required to be presented in accordance to the provisions of these standards. So when carrying out an examination of the financial statements, an auditor also checks if the company complied with the requirements of international financial reporting standards, international accounting standards, and so on. You understand? So these are 5 objectives of an audit. 1, provides reasonable assurance. 2, enhances credibility. 3, can help identify and recommend improvements, identify weaknesses in the internal control system and recommend improvements, can deter fraud and error, then compliance with regulations. Now, it's important to note that an audit does not guarantee that the financial statements are completely error-free. That is not the objective. The objective of the auditor is not to give a guarantee that the financial statements are completely error-free or that they have errors, nor does it guarantee the future viability of an organization. Instead, it provides an independent assessment of the financial information based on the evidence available at the time of the audit. And we'll be studying how that is done as we'll be going through the process of auditing and the process of gathering evidence and how, based on the evidence, the auditor is required to make a report. We shall also be looking at different types of reports that may be generated by an auditor based on his examination of the financial statements. For now, we are going to take a break. But before then, here is your today's assignment. Number 1, what are the primary objectives of an audit and how does it differ from absolute assurance? Number 2, explain the concept of reasonable assurance in the context of an audit. Number 3, how does an audit contribute to enhancing the credibility of financial statements? Number 4, describe the role of an auditor in identifying weaknesses in internal controls and recommending improvements. In our next session, we're going to study the development of audit, that is the early audit and modern audit. Bye.